Folks, go ahead and hold on to your seats because we are already starting the year with violence and we've got a lot to discuss from the battlefield. Number one asset that the market is rushing into at a record pace. What and why? What does history suggest is coming? Number two, an insane solution to the crisis that is being proposed by a so-called renowned economist. Number three, an update on Tesla and the top trades, including our Jasper FDA play, which succeeded this morning. Timestamps down below. And today's video is brought to you by the Moomoo trading platform and broker. It's an excellent app to help you take your trading to the next level, and they are offering up to 15 free stocks if you sign up and deposit using our link down below. Okay, so people are rushing to get gold at a rapid pace due to garbage fiat currency being destroyed by junkyard policies. Gold has been skyrocketing for decades and really since the beginning of time. However, right now is particularly unique. Gold is surging to a 6-month high and looks to be gearing up for a breakout to a new all-time high. Now you may be asking, but Charlie, why? Why would a shady government-backed paper with a similar consistency and abundancy of single-ply toilet paper be buying less and less of precious gold? It just doesn't make any sense. Well, Eric Strand, the manager of the AUAG ESG gold mining ETF, said this to CNBC. It is our opinion that central banks will pivot on their rate hikes and become dovish during 2023, which will ignite an explosive move for gold for years to come. We therefore believe gold will end 2023 at least 20% higher, and we are also seeing miners outperforming gold with a factor of 2. Interessante, so he's in on the pivot narrative. The central banks will destroy the economy and then come to the rescue, but in rescuing the economy, they will destroy our currency and then drive up the demand for gold. Now I know what you're thinking, Charlie, this is from a gold mining ETF salesman. Of course he is bullish on gold. Of course he is bullish on gold miners. But folks, don't even worry. We know we can trust that he's moral and not self-interested because his fund has ESG in the name. Duh. I don't know about you, but if I'm going to buy something, I like to know that it has applied at least 15 arbitrary guidelines so that I don't offend anybody with my potential returns. It's also fun at parties to brag that you're more socially acceptable than your peers. Oh, you invested in Tesla? Ah, you must hate the environment and social governance. I actually care about those things, so I invested all of my money in BP and Exxon. Much better ESG scores. That aside, the point here is that according to this narrative, gold is skyrocketing and will continue to skyrocket as speculators are anticipating a Fed pivot that then collapses our currency. Another big wig, the managing director and chief investment officer over at Swiss Asia Capital, said that current market conditions mirror those of 2001 and 2008. In 2001, the market didn't just move 20 or 30%, it moved a lot. The same in 2008 when we had a actually smaller sell-off in the market and the stimulus coming back in, and gold went from $600 to $1,800 in no time, right? A 3x. So I think we have a very good chance that we see a major move. This time around, gold prices could surge to $4,000 per ounce in 2023 as interest rate hikes and recession fears keep markets volatile. The spot gold price right now is $1,824. If we hit $4,000 this year, that's a more than double. And quite frankly, folks, the fact that gold prices are going up and in a 6-month high means that this narrative is winning. When the Fed raises rates, all else being equal, it causes people to sell their gold and get a risk-free return at the Treasury in bonds or bills. But when it's expected that in the near to medium term we are heading for an inflationary bust, well, people rush to safe haven assets like gold. In an inflationary bust, the currency collapses and the economy is doing horribly. Faith in the financial system is called into question, and the last thing you want to be in is locked up in underperforming bonds, right? For example, who would want to be locked up in a 4% treasury bond when inflation is stuck at, say, 5%, and the central bank daddy is signaling that we are going back into stimulation, which means more inflation not so far away? Right? So this is the situation that you head into, and this is what people are trying to prep for. And as Robert Frost once said, nothing gold can stay, or in this case, only gold can stay. I believe you're going to continue to see gold skyrocket throughout this year, but it'll really start skyrocketing once the Fed pivots before it even gets to that inflation target at 2%. Next, do you want a good analogy for what we are going through? Well, Nobel laureate economist Paul Krugman is out, and he has a great analogy for you. He says that controlling inflation by inducing a recession is like stopping the action on the field until everyone sits down again. It works, but at a cost. It only stops when the various players are forced to accept the outcome. You need businesses, consumers, and entire institutions to accept that they have to change their behavior because things have changed. In a stimulated environment, demand goes to the roof and businesses raise prices. businesses. Employees demand higher wages to pay those increased prices across the economy. And then businesses who have to pay higher input costs, higher labor costs, then further pass on those price hikes to consumers. And until all parties decide to sit down and stop, you're stuck with self-defeating inflation, and it takes a long time for people to sit down, right? And so the Fed has to go more and more aggressive to force the entire game to stop, in which case everyone sits down because there's nothing left to see. He argues here that if we could just get collective agreement by everyone to all just sit down at once and just not completely stop the game, but just all agree to sit down, well, we would see a lot less damage. Yes, let's just tell all the businesses and workers to take the L because of sloppy policies coming from central bankers and politicians. Yes, let's go ahead and let the irresponsibility of the last 3 and really 10, 20, 30 years all just go and rest back on the hands of everyday consumers, everyday small businesses, and increasingly corporations, which quite frankly are getting destroyed week after week after week. And you're really going to start seeing them get destroyed in not just stock price, but actually earnings in the coming quarters. Let's just tell everybody except for policymakers that they are responsible for the failures. This is actually pretty hilarious if you understand who Paul Krugman is and his branch of econ and his branch of thought. For context, Paul Krugman wrote many of the econ course textbooks I was assigned when I was at the University of Cali Brainwash. Like most econ curriculum authors, he's a Keynesian, which means he belongs to the we can spend, print, borrow, and stimulate our way out of any problem club, which, by the way, is a necessity if you want to sell textbooks at universities and you want any sort of Nobel accreditation. You have to believe in sloppy policy or you're not even considered. But it's ironic because he's suggesting that we fix the results of flawed policies that he preaches and praises by simply asking businesses and consumers to take the L and sit down and sit out. Let's be real. Employees have already taken the L. Their wages haven't kept up with inflation. Many small businesses are increasingly taking the L. Even if they did well the last couple of years, they are seeing huge demand drops and input costs are still very elevated. Wait until we get to the rest of 2023. And like I said earlier, even the biggest corporations are going to be starting to take the L, and they've already been hit very, very hard in stock price. So in my opinion, the only people that need to sit down are these moronic policymakers who tell us to save our dough for a rainy day, while they themselves are either running an insane deficit or, in Krugman's case, is preaching policies and economic theory that includes running up a massive deficit. My thought process on this is quite frankly very controversial. If you hire someone to do a job and they fail again and again, just hire someone new. Next, Tesla. The Musk-Meisters Tesla is down again. They reported deliveries that are at about a 3% miss from Wall Street expectations, and at the time I was shooting this video, they dumped another 15%. Now, I'm seeing people on Twitter saying Tesla doesn't deserve this beat down over a 3% miss, but remember, folks, this is the best Tesla is going to see for the foreseeable future. The economy is going to get substantially weaker in 2023 than it was in 2022. We are downtrending from peak for Tesla, and it's going to be that way for quite a while. And while Tesla is doing record deliveries, quite frankly, this is already the 3rd delivery miss in a row. People bought Tesla stock with much cheaper money in a much cheaper environment, expecting better execution, and now the world has been turned upside down. The amount of capital that is in the market willing to take these hits is just much less than just a year ago. And it's going to increasingly get vacuumed out more and more and more. And people are like, okay, I want to bail now and then get back in later. I've been very vocal since the beginning of the year about my thoughts that Tesla is going to go down a lot farther in a drawn-out recession. I'm bullish over the long run, but very bearish over the short run. The Fed, again, is sweeping the market of excess capital, and Musk is toying with his investors' patience. And, of course, overall, luxury cars do worse in bad times than they do in good times. I'm pro-Tesla. People think I'm making an argument against Tesla when I say things like Tesla has a lot more to go down. No, I'm just saying that you can't be bearish on the economy and bullish on Tesla in the same time period. You can think that Tesla is a great deal over the long run, but you can't say that in a short-term time horizon when literally people aren't going to have money to go out to eat, and you think people are going to go and buy out these very, very expensive cars. You go back and you look at the dot-com bubble bust, you had some of the best companies who barely saw any income drop lose 95% of their value, but this time is supposedly different, right? In my view, this will end up being a great buying opportunity, but you have to have the right expectations or you're just going to lose money and probably get wiped out. If you are buying here, my only suggestion is to not look at your position for years, because I expect that Tesla will go down much further before it rebounds, and the rebound will be a lot slower than you may have been accustomed to. I think you're going to find Tesla at another 20, 30, maybe even 40% lower prices than we are now. I would not be surprised if it drops even lower than that. The market can stay irrational longer than you can stay solvent. So if you're going and buying on margin, you're going and leveraging yourself up to your eyeballs like I see a lot of people doing to buy the dip, well, be aware that Tesla may not rebound as fast as you think, and it might go down a lot more. Nobody has the money or cares about the fundamentals of Tesla and the growth story over the next couple of years right now, and it can take some time for that to recover. So be aware of that if you're going to take a position. Anyways, let's go ahead and talk trade. So we did have a winner this morning, JSPR. We said this morning, Jasper announces positive phase 1 and 2 trial data, sells off from original reaction. Any rebounds coming after open / the rest of the week. And yes, that rebound did happen. We briefed on it at roughly 99 cents, 30 minutes prior to market open, and it ran into open and then popped up, saw a bit of a take profit panic, and then rebounded to 380. That's about a 283% increase, briefing price to highs. Now, I've been talking the last couple of weeks about how early 2023 is going to see a ton of FDA approvals and FDA updates, and this is exactly what I mean. I expect to see a lot more of these, and we will keep you updated in the briefings and shortly after on the channel if they happen. But this is indeed the usual ZipTrader playbook that we talk about. Oftentimes, you get a positive FDA catalyst during extended hours, and it doesn't have a real reaction until the rest of the market finds out about it after market open, and the rest of the volume flows in. So if you're paying attention and awake in the pre-market, you have a better chance of finding these opportunities. Now, it's not easy. You have to wake up early and track these catalysts and identify the trends, and you have to do that consistently day after day. I'm actually in Dallas right now because I wanted an extra couple hours of sleep. In LA, I got to wake up at 4:30 or 5, here at 6:30 or 7. But in any case, keep your eye out for FDA catalysts that are dropping in the pre-market, because those are some of the best opportunities that I see heading into the next couple of weeks and probably deep into February. Next, I'm also starting to notice that certain plays are seeing delayed effects. For example, we briefed on ATNF at 193 after an unusually active pre-market on the 27th, but it actually ended up failing pretty spectacularly and dumping like 25%, and then all of a sudden, Friday and this morning, it just goes parabolic and breaks out into new highs. So if you're someone who is following trends and looking for trading opportunities, pay attention to what tickers are seeing unusual trading and follow up with them over the coming periods. Now, obviously, not all of our trade ideas are winners, and yours won't be either. If you do decide to join us, though, the goal of our briefings is to brief our members on the potential catalyst to know. Some run, some don't. Some run a couple days after, some run the day of. It depends. We don't have control over the market, but we do have the ability to identify opportunities and show up every day, right? That is the goal, and that is what I think that every trader should aim for, whether they are a member with us or not. And by the way, you don't have to join us to make your own morning briefings, and if you are a member with us, you can still make your own morning briefings. I think that it's very, very important to be self-sufficient and find your own opportunities, but we do have this resource for you if you would like our take on it. Make sure to use coupon code HELLO2023 to get a discount on our full program. And always hit that ravishing like button and subscribe, and we will see you in the next video.